All right, so hopefully you got through the article and watched the video. I'm not sure what your impression of the video was. Very different than the articles, so hopefully gave you some perspective that wasn't too industry, pro-industry. So let me get down to that. I'm actually going to jump to the article here pretty soon, but I just want to get to where we are in the notes. We've covered quite a bit on the homeowner side. Right. And the Insurance Council in Texas gave us another $2,000. So, you know, Lindy, if you have actuaries that need exam help, make sure they know that money's there. Did they take care of you okay? Yeah, if you haven't had it yet, email me every once in a while. They have a new person there and they're not really sure what to do. So yeah, we can use that money. We need to use that money. All right, so let's talk about this mold in Texas issue. Let's start with the article. I think that's the best way to get through it. And Jacob, if you're not seeing what I'm showing, not that one, the other article, sorry. If you're not seeing the this toxic mold in Texas homeowners insurance, then let me know. All right. The title of the article tells you a lot. And they've used the word toxic. The word toxic, you know, implies talking something poisonous here. This was a huge issue a few years ago, several years ago. It's not really in the news all that much today, although I do hear mold stories still around when people have serious mold issues. So it's still out there as an issue. It just hasn't been an issue for homeowners all that much. Why do I like this one? Because it brings up a really, really critical point from an actuarial standpoint that I want to make sure you see in this analysis. There's a few other points too, I think, that are pretty important as far as who the players here are in the insurance industry. And then I want to take that implication of that and talk about homeowners insurance related to hurricane and storm surge, because it's a critical issue as well. So let's see if we can, there's probably a way I can get rid of this, I would think, but I don't know how to. So anybody know how to?
To the top left.
Is that? There you go. Thanks. Okay. All right. So you start off on the exam. Essentially, your exam answer follows this article almost verbatim, because this article is written in the right order. So it makes a lot of sense. So you start off with this. Just why is this such a big issue? Well, in Texas, homeowners is already the most expensive. Texas is already the most expensive state in the country for homeowners. Did y'all know that? Not Florida, not California. And why is that? Because we got it all. We get hurricanes, we have tornadoes, we have ice storms, we have hail storms, which are pretty horrible in Texas. You know, we're Hurricane Alley. Dallas gets hotter than San Antonio in the summer and gets colder than San Antonio in the winter. It's just like a really horrible place with a lot of tornadoes, and it's just really, really dangerous place. Floods as well. We saw Harvey a few years ago. So Texas is already a very, very expensive state. So you want to get that into your answer. You can, since this is an open book exam on this part of the question, you can certainly quote this. So Texan homeowners pay premiums averaging 83% more than the national, or 83% more than the national average. That's pretty significant. Now, it's maybe not as bad as it sounds, because, you know, a lot of people are spending, I don't know, $200, $300 a month on auto insurance. For their homeowners might be $100. So it's homeowners is generally not as big of a ticketed item as auto, but it's still, you know, significant for people to spend that kind of money. And then the mold issue hits. So you're already starting off the most expensive in the country, and this issue hits, and now the insurers are saying we want steep increases in our premiums. How in the world can you have steep increases where you're already the most expensive? And this article sticks with that toxic mold. The industry doesn't like that word toxic mold. It's just mold, but the word toxic mold is if this is some new thing that just came to the world a few years ago. I mean, there's toxic mold in ancient literature going back thousands of years, so it's been around for quite a while. How much do they want to increase the premiums? 40 to 60%. How can you increase your premiums 40 to 60% when you're already almost 100% higher than the rest of the average of the rest of the country, right? So it's pretty significant. So insured losses from water and mold damage in Texas will reach at least $780 million, up 60%. All right, so here, what do you want to make sure in your answer? I'm real picky on this. I was picky on this as with your first paper as well, is make sure you get the terms frequency and severity into your paper. I always want you thinking frequency and severity. So the question is, which of these is frequency, which is severity? So number of claims has risen fivefold, while the average cost per claimant has leaped from 3,000 to 38,000. Which of those is frequency, which is severity? So the average claim is severity, and the number of claims is frequency. All right, so they don't use those terms, and in your answer, I want to say the frequency of claims, that is the number of claims, was up fivefold, while as the severity of claims, that is the average claim, rose from 3,000 to 38,000. All right, I want you using those terms, even if the article doesn't use it. That's pretty scary that they're both up fivefold and then essentially 15-fold or 13-fold. So something's obviously happening here. And that's on top of everything else I have with hurricanes and everything else going on. All right, so who are the players? So let's think about the players. Obviously, we got the consumer, but when you think the consumer, I want you thinking two people. You got the consumer who never files mold claims, and you have the consumers who file mold claims. We're going to talk about those two groups. All right. We have the insurance companies, obviously, they're a player. So here's another group to add. Mold remediation companies. These are people who go around door to door and they say, can we come in and check your house for mold? And they probably say toxic mold, right? They probably can find a more difficult word. Can we check your house for toxic mold? And the insurance industry was saying, hey, there's people out there that are doing this and it's fraudulent. They're finding mold when there's no mold. They're scaring people to death. I remember back at the time visiting some houses. We helped this one couple move. And so we're in their house moving stuff, and I opened the doors. I think it was the bathroom. Opened the door, and there's nothing there. There's no floor. I was like, man, you should put a sign up here. It's just dropped to the first floor because they were gutting the entire house because they had mold in their house. So you got the mold remediation. What other groups do you have? Well, we'll catch the other ones. So two groups of consumers: the insurance industry, the mold remediators, the real estate brokers. What do real estate brokers want? Do they get worried when insurance companies stop selling homeowners insurance? It's a little bit of a problem, right? It's hard to sell a house if you can't buy homeowners insurance. So they want this problem solved. They don't really care what the solution is. They just want it solved because they can't sell houses if people buying houses can't get homeowners insurance. Mortgage banks, they're not going to loan money without homeowners insurance. So they have invested in it in interest. Home builders, they may be the cause of the problem. We'll see, maybe the way they're building the houses is causing more mold. So that's part of it. So the home builders, construction, home repair business, all these people, that's another group. How many is that so far? 6 or 7? I don't know, I can't keep track, but y'all got, how many y'all have? 6 so far or 7? 8. Okay, I can't even count. All right, so there's a lot of people involved here. Let me add another group. They're called regulators. So the regulators, what do the regulators want? I just want people to leave them alone. Let's find a solution, get it done. And you might add regulators / politicians. So the legislators are also involved in this, but you can put them in one group. Here, the particular regulator we're talking about is Jose Montemayor. I have 2 students this semester whose last name is Montemayor. One of them had never heard of Jose Montemayor. The other one had heard of him, but doesn't think she's related to him. But really great guy. I wish I could have him come talk to the class. So the regulator, and here specifically Jose Montemayor. So you have the legislators, the regulators. What are they looking at? Right. On the insurance industry side, the insurance industry has said, we don't like rate regulation because you won't let us charge enough money. But we found these special purpose entities where we can sell our insurance from them and we can charge whatever we want to. Whether they're county mutuals or Lloyd's, these are companies that are exempt from the rate regulation. And so some people are saying, hey, let's regulate rates for those companies. Let's make sure the remediation companies have some licensing requirements. Let's regulate that business. Or let's have some standards on air quality. What is good air quality? When do you know someone's house is dangerous? Let's change building codes to ensure materials are less susceptible to water and mold damage. And the air quality standards. Okay, so those are things. Let's go after the insurance industry. Let's don't let them charge what they want to charge. Let's make sure we don't have fraudulent people doing stuff that's causing these claims to go much higher than they should. And let's see if we can fix the problem long term and just eliminate mold altogether. All right, so let's get a little bit of history. So here's where you watch the video. Ballard's, right? Her name's Ballard and his name was something else. Yeah, Allison and Ballard. Ron Allison and Melinda Ballard. All right, so you definitely want to put the history in here. So you start off with Texas is already very expensive, and now they want to increase more. Talk about frequency severity. Here's the players. Let me give you a little bit of the history. What's the history of this thing? How did all this develop? And a big part of this was the headline, one big story. It hit the news. I'm convinced, watching a video, I'll see what y'all think. I'm convinced that the Allison Ballard couple, they actually had a legitimate complaint. They really had something dangerous, but I'm also convinced that their mold issue was a fairly unique one. That they had kind of a way out there on the left tail kind of risk, which is not the typical mold risk that everybody else is facing. That's my opinion, just because I have not heard many stories like hers out there. And it's really her story. Why? Because her husband really couldn't talk on the film. What was his problem? He has some pretty serious cognitive issues coming from the mold. So, and their son had some serious issues. So there's a key word right there. Homeowners exposed to toxic mold alleged many adverse health effects. What does the health insurance and what does the property and casualty insurance industry say? Hey, mold's not an issue. You get out some Clorox, clean the mold, no big deal. And not only that, can it cause you health problems, but fixing it, we're gonna have to gut your house. You're gonna have to go live somewhere else. We're gonna have to pay for your apartment. We're gonna have to reconstruct your house. It's very, very expensive. So it's bad for your health. Property damage is extensive. Consumers were blaming new home builders, shoddy work, low quality construction, that it was the home builder's fault. I don't know if home builders have actually changed since this time to fix these problems, but Texas, you know, when we get rain, we get a bunch, and you get leaks and all those kind of things. And if you don't clean it up immediately, yeah, it can cause some serious problems. But I think the big thing was this headline risk. Where I ride my bike, a couple moved in, and I meet them. I go, hey, good to meet you. Where y'all come from? Oh, we used to live in Dripping Springs. Oh, Dripping Springs. Do you know the Ballards? Oh, yeah, they're really famous. he knew this case off the top of his head, but he and his wife both. It's like, oh yeah, and you want to guess what their perspective was? Were they like the insurance industry, they were really ripped off, or the Ballards, they were really ripped off? Which side do you think they took? The Ballards, yeah. The Ballards are like folk heroes in Dripping Springs for taking on farmers and winning. So that was their first. I didn't sit there and talk to them about it. It's like, well, I used to think about this. And then, it's like they didn't care about that. But yeah, I mean, it's interesting. They knew these people. Dripping Springs, I don't know if y'all know where Dripping Springs is. It's kind of, it makes sense that you would have a mold issue in a city called Dripping Springs. Sounds like there's a lot of water there. It's a pretty small community. It's probably been completely eaten up by Austin by now. You can hardly tell when you leave Austin and enter Dripping Springs because it's just Austin moving out so fast. So they filed a $32 million lawsuit against farmers. Farmers, I think, was the 4th or 5th largest in the state. They probably tell you somewhere in here. But Farmers is a pretty good sized company. Some of y'all probably have Farmers insurance. Farmers is interesting because it's similar to USAA as being one of those reciprocals. So it's an interesting structure. So their complaint is, and if you watch the video, that was her thing is, we've got a problem, Farmers come fix it. And Farmers was like, no, we can wait, and they were delaying it. And her argument was, if they'd come in and listened to us and fixed it, we wouldn't be where we are now. And so they're suing for $32 million for the delay in remediating repairs for a water leak, allowed toxic mold to spread throughout. Now that's kind of interesting. 22 room. They say new home. The video didn't look, the home didn't look all that new to me. Their style of interior direct decorating is not my style. It was a really dark, very dark, dark as far as no light and dark as far as all our color choices. So, I didn't like that house much at all, but massive house, right? Pretty good sized house. So obviously they're a fairly wealthy couple. They asked for 25 million actual damages and 75 million in punitive damage. So I don't know the difference between the 32 and the 100, but probably some adjustments here. And what was really interesting here, we're going to see this in another case when we get to asbestos. The judge says you cannot bring in expert testimony to ask whether mold really is bad for health or not. That seems unusual. Why would you exclude that? We're going to see the same thing on asbestos, where judges were not listening to the health experts. They're just assuming these people with no signs whatsoever, any health effect, were getting thousands and thousands of dollars just because they could say I was exposed to asbestos, and that's changed. But here, the judge is saying, hey, you can't, insurance industry, you can't come in and say, hey, the mold's really not that bad for your health. They must have gotten something else. Something else must have happened to them. It couldn't have been the mold. Now, watching the video, I do think it's the mold. The thing I thought was most shocking on the video, I remember when the guy just walked in and he ran out really fast. You remember that guy? He's like, wow, there's something evil in here. Now, I don't know if, he knew that in advance that he was going to do that or not, but, it's kind of scary. You walk into a house, you get immediately notice that, you're getting attacked by mold. The verdict prompted farmers and others insurers to stop offering insurance to customers. Now, so here's the trick of the insurance industry. Everybody hates us. We're always the bad guys. But if we take our toys and go home, guess what? We got realtors that are going to fight for us. And realtors have incredible power with legislatures. In fact, probably half our legislators are realtors. So we'll just say we're not writing any more policies and we don't have to do anything else. The realtors will go out there and fight for us. And that's essentially what the industry said is we're not going to write any more policies. We're out of this. See you later. And boy, they had a great army back there protecting them. The final solution, the TDI, you know what that is? Texas Department of Insurance, a bunch of regulators. They said they would cap losses at $5,000. The insurance industry said, no, we're not going to do that. That's not enough for us. Capping it at 5,000 is not enough. Now, I'm kind of surprised capping at 5,000 wouldn't have made them happy, but they are worried about that 5-fold increase in frequency. It's not just the 38,000. It's also increase in frequency. Real estate and mortgage banking industries protested that many home sale closings were delayed due to the inability to get insurance. Insurers complain of unscrupulous contractors. You know, it's all these documents. Now, I remember back in this time, it was really, really quite fascinating. People would have something in their house catch on fire. They would have hail damage, and they just wouldn't call their insurance company. And why? Because they say if you call them in with a claim, they just cancel you. They pay your claim and they cancel you. So people were paying all this money for homeowners insurance, and they were not filing claims. And I'm thinking, well, that kind of defeats the purpose of having homeowners insurance. So people are just like, I'm not going to file a claim. I'll just pay. It's a few $1,000s. I'll just pay it out of my pocket because I don't want to lose my insurance. That's as bad as it got. People were just freaked out that they're going to lose their insurance. So you see the power of the insurance industry is you guys hate us, but you need us. So we don't have to be here. We can go do something else. And so that's the power that they have. They've done that in other states as well. They've done it in New Jersey on auto insurance. They've done it in Florida on homeowners insurance. All right, so there's the history. You got a market, we call it, you know, it's just a market breakdown. The market for homeowners is just not working. The people selling it says we can't make money doing this. The people buying it are either saying, you're overcharging us, we need mold coverage, or hey, we never wanted mold coverage in beginning with, why do I have to pay for all this? Those two consumers. So let's talk about the health issues here. Mold is a common problem in buildings. It can become a serious problem when mold spores multiply unchecked. But is it serious to everybody? There's no conclusive links that have been established between mold exposure and serious health problems, unless people with allergies and suppressed immune systems, they're more exposed. Now, I don't know with this family, there's the man and the son. It seemed like she had no problems. I didn't sense anything from her that she had any problems at all. Oh, did she? Oh, I don't remember that. Oh, that's pretty cool. Yeah, I remember. Oh boy, you do that today, boy, you'd be in a lot of trouble. So she was impacted somewhat, but she's saying, you know, mentally, she seemed to have all her faculties. She's very articulate on the interviews. So they're saying there's no link. It's hard for me to imagine there was something else affecting that family other than the mold that just had to be coincidental, you know, but maybe it's the water or whatever. While no official government studies support claims of adverse health effects, some doctors and private practitioners assert otherwise. Chronic respiratory infections, asthma, skin rashes, chronic fatigue, short-term memory loss, that's what her husband was going from, anxiety, depression, headaches, nosebleeds. Because insurance companies did not respond quickly enough, their families were gravely ill and their pets were dying. That's pretty scary. Someone comes to your house and these are the kind of things they're telling you. You know, especially today, asthma in kids is a serious issue. There's a lot more asthma in kids today than there has been historically. You come by a house with small kids and they say, hey, if your kid has asthma, this can really cause long-term mental problems, cognitive issues. It's pretty scary stuff. You're willing to shell out the money to have them fix your house. But the insurance company says, no, we don't think that's a problem. We're not going to pay for that. That's the battle that you have. All right, so it depends on who you are, whether or not can be exposed or not. But my sense is there was something quite amazing going on in the Ballard's house. Some special kind of mold or some special exposure that just made that thing just go wild. All right, let's get a little bit of background on rates in Texas. Every state is different. Some states are completely unregulated. You just charge whatever you want to. Some states are hyper-regulated. Like the state of Georgia, not only regulated, but every county is regulated. So you almost have to file your rates in every single county, which is overkill regulatory. Hawaii is heavily regulated. California is heavily regulated. What Texas does is they say, okay, you know what? Charge whatever you want to as long as it's within this range. If you get outside that range, then you have to come and get approval from us. So as long as you're within the range, you can charge whatever you want to in the range. But and then if you're a county mutual or a Lloyd's, you're exempt from that. You can essentially charge whatever you want to. So this is called a benchmark system. It allows insurers to charge 30% more or less than the benchmark rate set by the state. If they want to do more than that, then they have to file with the state. Now, that's not true in California. In California, you have to file your rates with California, and they say no every time. I remember working with the actuaries at USA. I give them all my numbers. They write it all up. They say we need an 8.7% rate increase. Therefore, we're requesting 5%. It's like, wait a minute, I thought you needed 8.7. Yeah, but they won't approve 8.7. We just asked for 5 because that's the most they're going to approve. And so how do you make money? We don't make money. We lose money in California, and then we overcharge the people in Montana, and eventually, you know, it all works out. Why? Because eventually we're overcharging California, and we should be asking for a 10% drop, and we'll ask for a 5% raise again. And it all kind of works out. But that's the way some states are, very, very, very picky. So Texas is kind of in the middle. They have this range, and that range is based on what? It's based on the fact, why is Texas's range well above all other states? Because claims are higher in Texas. It's just homeowners insurance. We have more claims in Texas than in other states just because there's so many things that hit this state. So it's a flexible system, but insurance says we don't like that, so they're shifting more to these Lloyds, and Lloyds are exempted from the plan. TDI estimates that 95% of Texas homeowners policies are written by Lloyd companies. So why do we have a regulatory rate setting at all if you can avoid it so easily? And we're going to see it later. We're going to look at Allstate. And one thing you'll notice with Allstate, when you look at, they have a bunch of subsidiaries. It just goes on page after page after page. Many of those are things like Texas County Mutual, Texas Lloyds. They have a New York company, have a New Jersey company. You create companies to get around the regulation. They do that a lot. It's just the way you have to handle the regulators. How do you get around that? Well, in Texas, I learned this early in my career at USA, Texas is a form over substance state when it comes to regulations. As long as you meet the letter of the law, they leave you alone. You can do something that you know is way outside, you know why the law is written, what they're trying to accomplish. You can do something that obviously violates that, but it meets the letter of the law, you can do it. There's some things the lawyers would tell me, I go, you know, the law says this, we can't do that. It says, oh no, but look at that next line. It says, well, that doesn't apply. It says, yeah, that applies. We're interpreting it that way. It's like, you gotta be crazy. There's no one logically would read it that way. Say, well, the regulators do, so we're gonna do it, and we've always done it that way. And it's like, that's crazy. So Texas is a form over substance kind of state. So you meet the letter of the law, and you still get around the regulation. So they're having proposals to refuse to allow them to insure homes because of prior water damage. So, I mean, this is interesting, and you will see this. This is a bigger issue in Florida and California, but actually telling companies you have to do business in our state. That's kind of, to me, seems unconstitutional. You open a restaurant in Florida and you're losing money, and you say, you know what, I'm going to shut this down. And they say, no, you have to continue your restaurant in Florida. We're not allowed to shut it down. I say, well, I'm losing money. It's like, one California judge says, you have an interest, but not a right to make money. So, I mean, you'd be interested in making money, but that's not your right. So you have to do this business. So that's essentially what Florida said. Now, they didn't say you have to do business in Florida. What they said is, if you are doing homeowners in Florida and doing auto in Florida, if you get out of the homeowners business in Florida, you must also exit the auto. That seems unconstitutional to me as well. You know, because what about Geico? Geico only does auto, doesn't do home. Why aren't they saddled with the homeowners? They were just smart enough never to get into that business. It seems unfair. It seems illogical. But yeah, we have legislators saying, hey, I don't care you're losing money. You have to keep doing this. They noted that more than 90% of insurers refused to sell homeowners insurance policy if the consumer had made any kind of claim in a previous policy. So you can see why people weren't reporting their claims. 90%, if you filed a claim, they weren't going to give you new homeowners insurance, no matter what the dollar amount of the claim was. So what do insurers do? So in Texas, you paid more, but you got more. And so 90% of homeowners were HOB policies. Mold damage is covered if it results, this is really critical, from a covered loss such as roof, plumbing, or foundation leak. Why is Texas different than the other states? And the big issue with Texas, unlike other states, is there was no time limit. So you could have a leak today and the mold happens 6 years later, Texas says you're covered. Other states, there was a limit in time. So that's why it was a much, much bigger issue in Texas. So what insurers did is they started going to these much more restricted policies that we talked about, the HOA. So yeah, they essentially said, we'll still cover insurance, but we're going to be really, really restricted in what we sell. So here's Jose Montemayor, capping, but you can buy additional coverage if you'd like. So $5,000 coverage, apply the cost of test and repair, mold remediation, all of that towards the $5,000. So that kind of limits, you know, you might spend all your money just on those people before you even get anything fixed. If you wanted more than $5,000, you can buy 25% more, 50% more, 10%, 100% more. So $10,000 the most you can get. We saw the average claim was $38,000. So, you know, there's a lot of money that the consumer is not going to get there. And allow multiple claims within a year up to the policy limit. So supporters, the interesting thing here on supporters is there's one group of supporters, and then we get to the people who don't support it. It's these rivals, these two people who hate each other and they both don't like it. So we'll get into that. So the supporter is pretty obvious. It's going to be those people that say, just fix the problem. The realtors, legislators, let's just fix it so we don't have to worry about this anymore. So they say, hey, it's a good compromise. It balances the needs of consumers and insurers. Over half the mold-related claims are less than 5,000. So that 38,000 average claim must be obviously skewed. If 50% are less than 5,000, but the average is 38,000. I don't know if these two groups got their numbers from the same source, but they give them some coverage. So without making insurance companies insolvent. If consumers knew that only 5,000 we paid, then they'd be cleaning their houses a lot better. They'd make sure they don't have the Ballard case. So that's that morale hazard. It's like, you know, hey, make sure you wash, clean, you know. I forget in the Ballards, it seemed like it all started behind the refrigerator. Really wasn't a place that they could see. So, you know, it's hard to know that you would actually, you know, they could have actually cleaned that. Hefty increases in rates would harm all homeowners, even though only 1 in 100 actually file a claim. Higher rates are also reduce the availability of homeowners insurance, impede home sales. You can see that's where the regulators, the realtors, and the mortgage bankers are coming in. They also say, you know, this is all about this media coverage. You know, we got, I know people that were quitting their jobs to go into this remediation work. A friend of mine at work, he says, yeah, a good friend of mine called and he wanted to start this whole business just doing this and nothing more. So it must have been pretty lucrative to these people. And they're saying, hey, it's just this media coverage, let it all pass, everything will be fine. So that was their position. So I love how they have it, opponents and other opponents. So these are opposing groups. They both hate this for radically different reasons. So let's start with the insurance industry. Rather than more regulation, let's just use free market competition and let us charge the prices we need to charge. If frequency's up, if severity's up, let us just charge what we need to charge. We're there. One thing insurance industry will always say, so this is kind of important here. I think I have it in the notes. So this might be a good place to go in the notes. I just don't remember where I put it. Yeah, I don't know where I put it. We're going to definitely talk about it later when we talk about some other insurance. But there's three things that here we have: affordability, we have availability, and then we have adequacy. Affordability means consumers can afford the insurance. Availability means insurers can provide the insurance. And then adequate means the insurers are charging enough so they don't go insolvent. Insurance industry rarely talks about affordability. They talk about availability. What they mean there is if you don't let us charge enough, we just won't write the business and then it won't be available. So let us charge the right price and then everybody can buy insurance at the right price that reflects their risk. And then it will be adequate. Okay, so affordability, availability, and adequacy, those are the battling things going on here. And so what do you notice with the insurance industry? Decisions about availability and rates of both insurance be made by the insurers and consumers in open market, not by government regulators. So a good question, why is insurance regulated, whereas Pepsi, Coca-Cola is not regulated? There's not a regulator telling Pepsi what they can charge. Bank interest rates aren't really regulated anymore. Why insurance? And why property and casualty insurance? Because life insurance is hardly regulated at all. People get ripped off with life insurance far more than they get ripped off with property and casualty insurance, and yet those rates aren't regulated. Health insurance is pretty heavily regulated now, but it hasn't always been. So what is it about property and casualty insurance that consumers say we need a regulator to step in? Why can't we just have a competitive market? So it's kind of interesting. We'll talk about it later. Is there some antitrust going on here? Is there some collusion going on here? Some monopoly power? If you want to buy auto insurance, if you called 7 companies, would you get the exact same number from all 7 of them? Have they all colluded together? Geico is calling Progressive, Progressive's calling State Farm. Hey, we're charging $700 now. Do you think that's going on? Or do you think you're getting different rates from different companies? Homeowners. I remember when I bought my mom's house, I switched it from State Farm to UTSA. But the State Farm guy's like, no, we can get it to you a lot cheaper, a lot cheaper. And I'm like, yeah, but I don't want to pay 2 bills. So, a lot cheaper. What you're talking about, $5 a month? I'll just stick with what I have. But I get a sense there was some competition going on there. He knew his UTSA, so he probably knew what rate UTSA was going to charge me. He's like, hey, give us a chance, come over to us. And I said, no, I'm not. I'll stick with what I have. But it would have been interesting to see what the differences is. But that would be the argument, right? We're going to talk about that. Is there a serious antitrust issue with the homeowners business? Auto and homeowners are the 2 main ones we're talking about there. And so we'll see. We'll look at some of the numbers. Also, this is property insurance. This is not health insurance. They shouldn't be paying for people's health care. Your health insurance should cover that. So we shouldn't have these big policies. So they want to reword HB and HOB to more limit what's actually covered. So they don't have this unlimited loss exposure. And the insurers are getting blamed for the construction problems. We didn't cause this problem. People got cheaper construction. They're trying to save money. And now we're the ones bearing the brunt of this. Go sue the construction companies. Don't sue us. And then they're saying, we're not even sure it's really that big of a problem. We had this one big case, got blown out of proportion, and now people are freaking out. They hear they got mold in their house. Their kids are all going to have their IQs reduced, or cognitive skills reduced, or dogs are going to die. Was that really happening? Probably not, probably overblown. And then they did want to curtail this remediation business. They thought, wow, we're really getting ripped off here. These people, there's no standards. There's, you can't walk in and, wave something around and say, oh, your air quality is 6 and it should be 7 or 12. These are people that, who knows what they were doing. No standards whatsoever. And that's why everybody was just quitting their jobs and going and doing this. You would think people with some background in that area might do that, but it's like, no, we can make a lot of money doing this. All right, so there's the industries, like, we just want competition. Just let us charge what we need to charge. So that's not an argument against mold, that's an argument against regulation in total. Just let us charge the prices we want to charge, let competition take care of it. What's the other side? Well, the other side is what we call consumer groups. So what is the consumer groups? So how many of y'all in here are a consumer? Are there any consumers in here? Okay, so I'm assuming you're all a member of this consumer group, right? You pay your dues and you all a member of a consumer group. So what is a consumer group? It's usually trial lawyers, right? So the insurance industry, it has its consumer groups, that's just insurance companies, and trial lawyers have their consumer groups, that's really trial lawyers. But they don't want to say we're a group of trial lawyers, they want to say we're a consumer advocacy group. We want to advocate for consumers so they'll sue people so we can make more legal fees, you know. And the insurance industry does the same thing on the other side. So they say there should be no restrictions on coverage on mold. Texas already has the highest rates. Proposes that limit coverage. Rates should be coming down. If you're going to give us less coverage, rates should be coming down. You're already charging too much. What are you guys doing? New premium comparisons by TDI show that the vast majority insurers have priced their policy higher than the benchmark. Insurers could limit the cost of mold by responding more quickly after water damage was claimed. That may be a legitimate argument. I'm not sure this is a legitimate argument, mainly because I've spent too much time around actuaries. I kind of gotten to the point where if an actuary says we should charge $500, that they probably should charge $500. I don't know any actuaries out there going, you know, the model says charge 500, but man, we can really rip these people off and charge 1,200. It's just I've never met actuaries like that. Insurers could limit that with being faster, so maybe that's the case. Since most home insurers carriers are in Lloyd's, they're not subject to rate regulation. So, you know, these proposals are really only going to protect 5% of consumers anyway. A cap of 5,000 inadequate would shift. Now, this one I do not agree with. Would shift costs from insurance industry to consumers. So this statement to me doesn't understand insurance. Because what is insurance? Insurance is a sharing of the risk with the policyholders. So if the insurance industry has $500 billion in claims, they're going to charge $500 billion in premiums plus expenses plus profits. If they have $300 billion in claims, they're going to charge premiums of $300 billion plus expenses plus claims. What happens to their rates when claims fall? They charge less. And why do they charge less? Because if they don't, their competitor will, and they'll lose business. So to say it's going to shift costs, that's what the insurance industry does anyway. Insurance industry by its nature shifts all of its costs to consumers. You'll see how that's how the industry is set up. If more people have claims, they're going to charge more. Why is Texas so much higher than the rest of the state? Because Texans file more claims. It's not because insurers in Texas are a lot more profitable than other insurers in other states. In fact, I've seen some pretty good reports that insurers in Texas are actually less profitable than insurers in other states. They're actually not doing well in the state of Texas, even with their rates being that high. So they want to close the Lloyd's. What happens if you close the Lloyd's? Well, they're just going to walk away to business. So how do you do that? Well, tell them they can't stop writing business in our state, which again, just seems so unconstitutional to me. We're going to talk about the Commerce Clause and, you know, how can Texas tell a company from Illinois that you must keep writing business in their state? Doesn't the Commerce Clause in the Constitution says Texas can't regulate a State Farm? State Farm isn't domiciled in Texas. They're in Illinois. The Commerce Clause says what? If you're a business in Illinois doing business in Texas, it's the federal government that regulates you, not the state of Texas. So this sounds like a pretty good case to say, hey, you can't tell us we have to do business in your state. We'll just stop doing business in your state. But they actually want to give the commissioner authority to tell farmers, you have to write this policy. You have to write it within this range. We don't care how much money you're losing. You've got to do it. So essentially what they want to do is they want to shift costs, legitimate costs, to the consumer's costs, to shift it to the insurance industry. And they essentially want the insurance industry just to lose a lot of money and be happy about it. That doesn't seem to make a lot of sense to me. Okay, where does it go next? A bunch of articles. Hopefully you didn't read all those articles in between. So I think that was it, right? So those are the arguments. What did Texas actually do? I'll show you the update on that. Something pretty close to this. So let me show you an article that gives you the more up to date of what they actually. So this article doesn't have the final solution in it. Now at USAA, I don't remember this having been as big of a deal as it was, but USA was certainly involved in this. So all the big writers were involved with this. I just don't remember USA pulling back quite as much as they did. USA's biggest issue was Florida, no doubt. Florida was a huge, huge problem. And we'll talk some on that when we do storm surge, because that's a big issue. I just don't remember. It may have been a big issue, and I just can't remember, but it was definitely something that was hitting the press. Definitely something that the legislators were dealing with. So Jose Montemayor, he was in the middle of this crisis. He actually, when he came and spoke to this class, he spoke into this class twice. I was shocked what he said about this issue. He talked about the public forum on this and people coming in, and some of the things he said, he had this one sob story of someone coming in and, you know, how horrible this was all, that the insurance industry want to do this, and saying, hey, don't disappoint us, Texas. And I thought Jose Montemayor might be kind of sympathetic. And he said, yeah, well, I couldn't wait for that guy to get off the stage. He didn't buy it. He didn't buy the health aspect of this. He thought it was overblown. You can't tell that from his public comments, but what he said in the classes, he was very strongly on the industry side. This is overblown. There was no reason for them to cover this. The big claims are really overblown. So he was fairly pro industry on this. Most homeowners will still have some protection against mold, but coverage for expensive procedures such as air testing, disposal of mold contaminated items will be eliminated. Those who want full mold coverage will have to pay a higher premium. The insurance industry attacked a plan as too little too late. The industry had sought to eliminate all mold coverage in the basic policy. They essentially want to look more like other states and make it more of an immediate thing. Consumer groups also, there it is, consumer group, there you are, also criticize the decision is giving away too much protection for homeowners. Just a quote in this article I think is pretty hilarious, we'll get to. Now here they say ninefold this year from a year ago. So I don't know if that's just more updated. All three of the state's largest insurers, Allstate, Farmers, State Farm, had quit selling comprehensive policies. Farmers has announced it would quit selling the HOB. Farmers hopes to persuade its consumers to buy a limited HOA. I don't think I even showed you HOA. I think we just started with HOB because it was such a rare policy. So Farmers isn't leaving the state. They're just saying, hey, you're going to get a very restrictive coverage. And we saw that when I listed the perils. You can see the perils of HOB included that water damage. It is a Texas homeowners who will be forced to pay the price in terms of higher insurance premiums for less coverage. Now, is that true? What if you gave more coverage? What would happen to their premiums? Go up even more, right? That sentence doesn't make a lot of sense. So they're going to pay higher premiums, they're going to let less coverage. Well, if they got more coverage, they'd be, you know, just not a good understanding of this entire industry. His order retains some existing mold coverage in the standard policy, only if it is a water leak and is reported in the policy within 30 days. So he put that restriction in that you see in most other states. Okay. I guess that was a quote. There was another quote. We may see it later. There's a really good quote that just completely misunderstands insurance. There's a lot of people who think insurance is this thing of these companies that kind of charge these random amounts and they're making bukus of money. There's, you know, making all this money. It's completely unrelated to claims and they charge whatever they want to. And it's just like, no, this is a cost plus business. They charge you what they think you're going to cost them. And that's the nature of it. That's what actuaries are trained to do. Actuaries aren't trained, you know, if your goal is to charge the highest you can, that's not the way it works. It's figure out how much you're going to pay in claims, frequency and severity, and then add expenses on top of that. All right, let's look at the class notes so we can make sure we have a good outline of this. All right, so it's kind of lengthy notes, so we're going to kind of skim through it real quickly. So the issue is frequency and severity. Consumer groups who are really representing a very small percentage of the consumers. And then you have the 99% that never filed a claim. So these consumer groups are really not the consumer, it's really the people who file the claims. You got the insurers, realtors, lawyers, regulators. I left out the construction people in there. You have a compromise that came in the end. No one seems to like it as far as the consumer groups in the insurance industry, but it's the final solution. So here's the key, and this you got to make sure you get this in your answer, and a good chunk of this class does not. What are we talking about here? In particular, we're talking about an actuary sits down, figures out how much they need to charge for this policy. They put that out there, that's approved by the state. They're charging this, and then some court comes along and interprets it in a way the actuary didn't intend. And suddenly claims are high. And so all the actuary can do is raise the rates. So what happens when you price a policy assuming one interpretation, and then the courts interpret it separately? So you have to realize when you talk about Texas government, they're not all the same people. You have the legislators that write the language in these contracts, then the governor signs it, but then the courts interpret it. And the courts don't always interpret it based on what the legislators intended. Sometimes you have courts that are pretty consumer friendly. So they may interpret it in a way that's not at all what the legislators intended. And so the insurers go back to the legislators and say, hey, we're getting killed with this language. Can you change the language? And the legislators say, no, the language is fine. It's like, yeah, but the courts are not interpreting it that way. And it's this big battle that they have. The only solution actuaries have, or two solutions companies have, is they can charge a lot more, or they can leave the business, get out of the business. And those are their only choices. They're not going to lose money. They're businesses. They got to make money. So they can raise rates and insure as it's been interpreted, if they can do it within the state. If the state allows them, if they're not over the benchmark more than 30% of the benchmark, they can leave the market or limit their business. But some states say they can mandate that you stay in the state, or you can lobby for change, or have your realtors, or you let realtors lobby for you. And that's been one of their approaches, is just let's unleash the realtors. They're a powerful voice in Texas. And limits on coverage, change the language, clarify that language. So how often does this happen? The two I'm giving you are the mold and the storm surge. I cannot think of another example like that, but there's other potential examples like that, like hurricane, like earthquake, and some others where the interpretation could radically change this. So if you're an actuary, you need to clearly read the language in your policies to understand what exactly are you covering. And make sure you're understanding what that means for frequency and severity. You're already in a pretty rough business where you're forecasting the future. If you're forecasting the future with ambiguous language, you're even in a worse shape. So you have to kind of think, what if the state interpreted it like this? So if you're actually writing this mold coverage, assuming, hey, we're talking about water damage and it gets reported within 30 days and we cover that, and then you discover, hey, no, it gets reported 6 years later, we're still covering that. It's like, wait a minute. And we're covering health claims and all this remediation, and housing's been built differently, so our frequency is going up. That's the life of an actuary. And they got to respond fairly quickly, because they're committed for a year. And then if they want to raise rates 40, 50%, that's really tough to do. Not just from the standpoint of the regulators, but also from the standpoint of your customers. Your customers don't want to pay 40% more. You get complaints. So it's a tough line for actuaries to be in this business. So that's the key. What do you do as an actuary or as a company where you're assuming your pricing is assuming one thing, and then the courts interpret the contract language in another way? So you got two articles on mold. We just covered the first and the second one on the mold. And then we have one article we're going to maybe start tonight. It's only 6 o'clock, so we still got 4 hours. So maybe start tonight. The key here, and the students also struggle with this. So on the exam, students lose a lot of points because they don't make this really, really clear that we're talking about contract language interpretation. And they don't make a good link on storm surge. A lot of students on the exam saying, this is also the case with storm surge, period. It's like, but how? How is it the case? So make sure you understand this. So how does storm surge have to do with this? So we'll get into storm surge and make sure you're real clear on that. All right, so before we'll come back to storm surge, let's say, I think I've covered everything pretty well. So this is just really just an outline. Here's a better list of all the players and their positions. Yeah, I think I've gave you an outline that covers it pretty well. So there's no reason for us to go through that again. You see it's almost in the exact same order as the article, if not the exact same article. So what do you do on the exam? You could do this, copy and paste it to me. What will your score be then? 0, right? I don't want to read my words. Plus, it's not all that well organized. So you need to, I wouldn't put it in bullets. I would put it more in prose with some good paragraphs, but you need to put it in your own language. So what I strongly recommend students do, read the article, read this, do an outline, and read that second again, and then type it off the top of your head in your own words. That way you don't have to worry about the plagiarism. And then go to the next section, read it, look at the words, and then type it at the top of your head, and you can go back and look and see if you left something out. If you do that, you'll probably be in pretty good shape. All right, so I've given you the outline of it. You just need to flesh it out. The other problem students have in my classes is they think I want you to know just sketchy high-level stuff. And I don't. I want you to know the nitty-gritty details. Why is that? Because I've gotten so many alum that got great jobs in this industry, and they said, boy, I'm sure glad we covered that in your class, because that issue came up and they were shocked at how well I knew that issue. All right, if you're going to work for this company, you have to know the nitty-gritty detail. Who are the players? What are their incentives? What's going on in Texas? You really have to know at that level. All right, so some of you are going to do horribly on exam because it's just way too high level and just kind of too iffy. So be specific. All right, so I'd recommend you go through the outline, read each section, read the article, and then put it in your own words off the top of your head. If you do that, you should be good. Should you cover everything? Yeah, why not? Why not cover everything? It's an important issue. So put it all down. All right, questions on the mold issue. So what could be the next mold issue? So I'm going to talk about storm surge that almost became the next mold issue. It would have been a much more gigantic problem than mold if it had happened. But there are some issues related to hurricanes and earthquakes that are, and part of it's probably even related to the storm surge. So let me set up the storm surge before we get into the article. The articles, I find it pretty fascinating. There's some stuff in there that I think y'all may find a little tedious, but I actually find it pretty fascinating. If you're going to work in this industry, I want you to be aware of the politics of this industry. It's pretty eye-opening and shocking to see what goes on. You got the evilness of the insurance industry, you got the evilness of the lawyers, and they're both in this industry battling for who's the most evil person in the world. There's some bad players in this industry. There's some good players, but there's some bad players. There's some bad players on the legal side. There's some good legal guys, but there's some bad ones. You're going to see the worst of it in this particular example. State Farm looks really bad. The lawyers look really bad, and they're both going on here. So what is storm surge? So if you have a hurricane hit your house and topple it, the wind is covered, but the flood is not. So let's say a major hurricane comes through, Harvey comes through. I can't remember if Harvey hit Galveston. Let's say Harvey hits Galveston and your house is completely wiped out, but you can't see anything going on. So you leave your house on Friday, nice, beautiful house. You come back a week later and there's just a slab there. So now you got to decide how much of that destruction was due to the wind and how much of it because of all that water that came in because of the storm surge. So the storm surge is the hurricane drags all this water in. Sometimes it can be 10, 15 feet of water, come in, hit your house. All you got is a slab. Anybody have any guesses? You work for State Farm and you got to figure out what percentage was wind and what, any ideas? Some of y'all are modelers. How would you actually do that? Would you rely on history? Would you rely on models? Would you actually engineer? Try to create small scale models to try to test it? Do you think they have the data to do it, or is it completely guesswork? They probably have set up videos in some places to try to catch and see what's going on. It's an interesting thing. It's pretty critical that they get that right. If it's 20% wind and 80% flood, they're going to pay half as much than if it's 40 and 60. So the state does have rules on how you split it, but there's some subjectivity to it. And then the insureds out there hiring their own people to say, this is what it is. What are they basing it on? Why does the insurance company come in with a low number and the plaintiff comes in with a high number? There's really no way to know for sure what caused what damage. But storm surge is not covered by homeowners insurance. So here's the key. Remember I said, what's the key? What if storm surge was the same issue with mold? What if the states did actually reinterpret the contract such that storm surge was covered? Homeowners insurance would no longer be offered on the coast or Texas. It would just completely go away. There's no way the insurance industry is going to cover storm surge. It's just way too massive. So they get out of business entirely. So we talked about this earlier. Insurance is a pooling of resources. That is, they're passing, it's essentially a cost plus business. They're passing their cost on to the consumer, and that's what the consumer is paying for. And they got to make their cost of capital. The only unknown here is the expenses. One company may be more efficient than another company, so they can charge less. But other than that, the claims are the same. The profit standards are approximately the same. So it's very similar. So this article, I'm just gonna kind of whet your appetite on this article tonight. So this is back to 2008. Most of it's related to Katrina. Boy, okay, I'm scared even ask. 2008. All right, y'all are alive in Katrina, right? Do y'all remember Katrina, or are you like still in diapers, or y'all remember Katrina?
Yeah.
Y'all might not have cared, because we had all these people from New Orleans coming into San Antonio. I remember they're over at the base. So we noticed it. So it's a Katrina thing. Katrina was more flood than it was hurricane. But that's where this really got tested, because Katrina caused some huge issues. So we've got a few players here. We have State Farm. There was other insurers as well, but State Farm was the one that kind of got caught doing something a little unscrupulous. You got this guy, Dickie Struggs, famous guy. He made hundreds of millions of dollars suing tobacco companies. Very wealthy man. Ended up going to jail after this article, so he's in here. We got the twin sisters, and you'll see about them. They were employees of State Farm who did some pretty unscrupulous things. You got a politician, Trent Lott. I don't know if y'all heard of Trent Lott. He looks really bad in this article. I don't know anybody that looks good in this whole case. So Trent Lott decides he's going to attack the insurance industry because they didn't pay his claim, and he's upset. He thinks he's getting ripped off. So he's going to change federal legislation to force, because he's just mad at his insurers because he had his house destroyed and they didn't pay for it. But here's a good phrase that's relating everything. If you're forced to rewrite your contracts retroactively, Not necessarily rewrite them, but reinterpret them. That's what I'm after here with the mold and with the storm surge. What if our contracts are interpreted in a way we didn't intend it? So Scruggs is going to go after this. He's going to bribe some judges. This is a guy who already made hundreds of millions, and he's like, that's not enough. I need a few more hundreds of millions. He was just like salivating, like, I'm going to make, this is going to be the greatest thing in the world. The problem he had, and you'll see it in here, is he set this up so that he was getting a lot of money from State Farm by threatening State Farm with this new legislation. And then State Farm essentially said, hey, we'll give you your money. You got to pull back on that. And then he's got to go back and get these people to stop doing what they're doing, or he's not going to get his money from State Farm. And then he's got this dilemma. And that's when he started bribing judges to get what he needed. So, I mean, it's stupid, right? If you have $100 million, just kind of stop there, right? Don't try to get that last million and end up in jail. So we're going to walk through this. It's a little lengthy, but I'll go through quickly. I think you're going to find some of this pretty eye-opening. This is an industry, when you have an industry that's paying out billions of dollars, and there's people who didn't get money they wanted and people who didn't, you have these lawyers over there that they see millions of dollars, really unscrupulous things start happening. And I don't think, y'all can let me know if anyone looks good in this. Maybe the judge that turned Scruggs in and wore a wiretap, maybe he looks good. I don't know, we'll see. But I want you to be aware of this industry, but make sure you're always aware of what issue we're having here. But here's the definition of storm surge: flood, surface water, waves, tidal water, semis, siege, overflow or body water, or spray of any of these, all whether driven by wind or not. That is not covered by homeowners insurance. And what does Krug say? That doesn't say storm surge. And State Farm says that's what storm surge is. So they're saying you have to cover storm surge because it's not in your exclusions. And they're like, but that's what it is. We can't cover it. So that's his argument. So we'll get into that. So some strange people. All right, I'll let you out a little bit early here, and we'll do this article next class. Any questions on anything? You have your paper 1 done? I don't remember when it's due. You should have it written. You wait too long, you're going to forget everything we talked about. You're going to be starting from scratch. So procrastination is a horrible thing. All right, so I want to do something that's really bizarre, but I do want to walk through this. I think it gives you great insight into this industry, especially if you're going to work in this industry. You're dealing with two of the most disliked industries out there, which is property casualty insurance and personal injury lawyers, and the two of them battling each other for who's going to be the most hated. It's interesting to me, those of you who took my life insurance class know I have a very negative view of the life insurance industry. I think there's a lot of really bad conflicts of interest in the industry, but that's not an industry that's hated all that much. This industry is hated a lot. I don't think it really deserves it. I don't think it's as bad of an industry. It has its problems and it's made mistakes, and you'll certainly see it in this article, but I don't think it's as uncompetitive, and it does as many evil things as the life insurance. And so we might talk, why this industry gets such a flack versus life insurance. When life insurance, you can just see much more questionable ethical behavior. And some people think, just the bottom line is that you have to buy this insurance. If you're going to buy a house and have a mortgage, you don't have any choice. You have to buy homeowners insurance. If you're going to drive a car, you have to have auto insurance. And some people say, since I have to have it, you're making me buy something. You don't have to buy life insurance. So that could be part of it. But this is an article that talks about something that really opens up a lot of this industry and the personal injury lawyers. So Katrina back in 2005 brought in storm surge, huge storm surges, biggest they've ever seen. It got I'm a plaintiff lawyer, Scruggs, so he's actually he's the lawyer, but he's also personally experiencing it. And as I said last class, this is the real key to all of this. So this is where students really mess up on the exam. They think I'm saying the contract were rewritten to reinterpret storm surge, and that's not what happened. It's what almost happened, but it didn't happen. If it had happened, it would have shut the entire industry down. You saw how on mold shut the industry down fairly significantly. Storm surge would have done that in a much, much bigger way. So Scruggs got 800 million suing the tobacco industry. So he decides to go after the insurance industry, but it didn't go well. He ends up going to jail, bribing a judge. So storm surge is not covered by homeowners insurance. It's covered by flood insurance, but flood insurance usually has a pretty low cap. You know, most houses on the coast are not $300,000 houses; they're multi-million-dollar houses. So if your cap is $350,000, you're really not getting much insurance. So you got a problem here where you've got a house. In fact, would be my number one reason not to buy a house on the coast, because you really can't insure it for one of your biggest risks, which is the ocean coming into your house. So Scruggs stepped into the breach. He hatched an audacious, demagogically, I don't know who wrote this thing, appealing plan, make the private insurers pay no matter what their contracts say. So Hood sued the 5 insurers doing business. So Hood, Jim Hood, you got to kind of understand who these people are. He's talking, let's see the first name, bring in Hood. I think he's the Attorney General, but we'll see. So Attorney General, yeah, there it is right there. So Hood is the Attorney General, not for New Orleans or Louisiana, but for Mississippi, because Mississippi got hit pretty hard as well. So he is he's the Attorney General. He sued the 5 insurers doing business in the region to validate their flood exclusion clauses as unconscionable. He argued that the clauses didn't pertain to storm surge because they didn't say storm surge. Instead, they said flood, surface water, waves, tidal water, tsunamis, sage, overflow of body of water, or spray of any of these, all whether driven by wind or not. Which is what? Storm surge. So you should have said storm surge. And that's the definition of storm surge. So State Farm say, hey, we don't cover this. It's clear in our policy that we don't cover this. And he's going to essentially try to go in and make them cover it. Unfortunately for the insurance company is they went after State Farm first, and State Farm, you can see what State Farm did here to get them in trouble. So it's pretty logical that the houses were damaged by wind, and that would be covered by the insurance. And it's pretty logical to think that the wind hit the house and then rain came in or the water came in, which means it's possible the wind did 100% of the damage. The water would have finished it off, but there's nothing to finish off, then you're 100% covered because the wind did all of the damage. So the question is, how much was left when the water hit? And that's impossible to know if you don't have anybody sitting there looking at it online. But once the surge reduced everything to slab, you couldn't tell what happened. And so they came across 2 engineering reports, and she claimed had been incompletely performed. So they found this engineer that said it was entirely due to the wind. And another one said it was extensively flood damage. And so they said, let's get another engineer to look at this. And they come in and they say, you know, it's more flood than wind. So essentially you get the sense that State Farm is engineer shopping here. They're trying to find an engineer that's going to cause them to have to pay the least amount of the loss. The dispute, and ever since, has been whether King was angry about shoddy work or about the report's conclusion, wind damage for which State Farm would be liable. So why is he asking for it? And then you get some employees. So the Rigsby sisters. So they discover these 2 contradictory engineering reports, and they suspect fraud. So they start photocopying these documents. Now, how many pages do you think you could photocopy at your company before they start thinking you're doing something? Could you do 500 pages, 1,000 pages? At what point you know, when you say, hey, I need another 7 reams of paper, at what point are they starting to think that maybe there's something? And how do you get out of the building? I don't think at USA you get out of the building with a suitcase full of documents. I think they would catch you. But anyway, I forget how many pages it was, but they tell you somewhere here in here. A few days later, Scruggs showed Attorney General Hoods the engineering reports for the same property. Hood became a criminal investigation of State Farm. Did they have a case? It sure sounds like it. If State Farm is shopping engineers that have to pay as little as possible, sounds like they have a case. Not only that, but remember who covers flood? It's the federal government. So not only are they defrauding people, but they're defrauding the US government and the US taxpayer. So that becomes even a bigger deal. If they're lying so that the US government pays more for flood, they're in a lot of trouble here. All right. So you see, State Farm, they have some serious issues here. And they are going to pay up. They are going to admit some wrongdoing. But this is only State Farm. They haven't found anything with the other 4 insurers, so it's only State Farm so far. It's only one company. So the Risbys allege that the insurers were fraudulently shifting their Katrina liabilities to the National Flood Program by characterizing wind damage as flood damage. When a whistleblower files a suit, they get 15 to 25% of the money that's recouped. Y'all know the whistleblower rules. Why did it do that? Because if you're whistleblower, you're probably going to lose your job. You might get a rash. You might get sued. So we have to give some incentive for people to come out and expose fraud. And so you get 15. There's people that have made a lot of money as a whistleblower, become quite wealthy as whistleblowers. State Farm didn't know about the Rigsby's, I can't say their names, Rigsby's sisters. So they downloaded more than 6,000 pages and made 2 copies of each. That sounds like 18,000 pieces of paper. How many reams how much is it? 500 pages in a ream of paper? How much is 18,000 divided by 500? So, I mean, that's a pretty good stack of paper, isn't it? And somehow they did it. And I mean, how long would it take you to do 6,000 pages? Copiers are not that fast, right? We're talking, they were up there all night. What was their boss asking? Oh, sorry, boss, we got a few pages we need to copy. You know, so they somehow got away with it. It's pretty interesting. They gave this to Hood and 1 to U.S. attorney and put a 3rd aside for Scruggs. Now they're now getting really shaky legal ground here and what they're doing, especially giving the data to Scruggs. But the morning after the data dump, they told State Farm what they had done. I don't know if they're feeling guilty or what. That's kind of strange. And they were terminated. Scruggs was then hired. Now, you can't pay someone to bring you confidential data for a lawsuit. So he couldn't pay them. So instead, he hired them as consultants, paying them $150,000 a year. They were assigned only vaguely defined duties and no prescribed hours. You can't pay witnesses for their testimony. But he didn't. He paid them as consultants. Now, even the article put it in quotes. So as consultants, Scruggs made the Risbys available for a series of press interviews. So Scruggs is now scoring victories. Now with the politics, 2 U.S. congressmen have become his clients. One guy from St. Louis, and then the most important one was Scruggs' brother-in-law, so the plot thickens, Trent Lott. I don't know if y'all heard of Trent Lott. I mean, he was really famous during his time. Does that sound familiar? Really well known. He was, you should go look him up on Wikipedia because he didn't end well. He made a really big mistake of complimenting someone with a really bad civil rights history, and he got in a lot of trouble for that. So he didn't end well. He's a Republican. So you think he might be a little pro-business, but here he had a house damaged and he was like, I'm going to make some money out of this. Lott and Taylor began supporting legislation that would uncannily further Scruggs in. Taylor introduced an amendment to require the Department of Homeland Security to investigate whether coastal insurers defrauded the federal flood insurance program. Law attached to the Homeland Security Appropriations Bill, so it's be certain to pass. That same month, he telephoned the president of National Association of Mutual Insurance Companies with a message so startling that he memorized it in a letter. Your comment that you will dedicate your next term of office to bringing down State Farm and industry through all means available to you, including legislation designed to harm the PC industry, was very unsettling to say the least. That's not what you want as an industry where you have a senator saying, I'm going to bring, just as a personal vendetta, I'm going to bring this whole industry down. That's not a good thing. So Lott and Taylor then joined an effort to repeal the antitrust exemption. We're going to talk about that later. That's McCarran Ferguson that says, hey, you can't, the states regulate the insurance companies, not the federal government. They wanted to bring that down as well. So they're just mad. Trent Lott is just mad that he lost money. He didn't get his full recovery on his house. So Scruggs and his law firm hired lawyers to protect the Risbys because obviously they're going to be sued by State Farm. They've taken confidential information out. So, and then Scruggs starts settlement talks with State Farm. Here's where he messes up. They reached a deal, so he's in good shape. State Farm would pay $80 million to the policyholder. Someone do the math on that. 80 million divided by 640. $125,000, not all that much, right? $125,000, and then the lawyers get $26.5 million. Sounds like which side of the transaction you want to be here, the policyholder, State Farm, or the lawyer? And the lawyer kind of does pretty well here. But State Farm refused as long as the politicians were after him. He's like, Scruggs, if you want your money, you got to get rid of these political hounds that are on my back. So now Scruggs has a problem. He's unleashed all these politicians on State Farm, and State Farm said, I'll give you $26.5 million, but you got to get rid of these guys. All right. Hood says he made it clear to State Farm that he would not combine discussions of civil and criminal cases. You're not supposed to do that. I set him at the table and pointed at every one of State Farm people. Says Hood, I said, don't even talk about the criminal investigation. But according to the state's deputy insurance commissioner, who was present at these negotiations, Hood's linking to the civil and criminal matters was at times both explicit and outrageous. He supposedly said, if they don't settle with us, I'm going to indict them all. That sounds like he's putting them together. Scruggs was impatient. He wanted his 26.5. Now, remember how much he got from tobacco? 800 million. That wasn't enough for him. He wanted his extra 26.5 million. But State Farm was refusing release until Hood's criminal inquiry was resolved. Scruggs offered Lucci and his business partner $500,000 if they meet with Hood and persuade him to drop the investigation. Balducci told Hood that if he didn't call off the probe, Scruggs would find a different candidate to run against him for Attorney General in the next year's primary. I don't know if that's illegal or not, but it doesn't sound all that good, does it? I remember at UTSA, they tried to get me to join their political PAC. I never did. I didn't want to be part of a PAC, even though the head lawyer at UTSA called me personally to ask why I wasn't joining. I was like, yeah, I'm not going to join. But one thing I didn't like about the PAC is they gave to everybody. They gave to every candidate. They gave to both Clinton and Trump. They gave both to Clinton and Obama and the Republican. They were giving like to everybody. It's like, why are you giving to every single candidate? I don't want my money to go to these people. It's like, well, we don't know who's going to win, so we had to make sure we grease all the wheels. It's like, I don't want to be part of that. So there's a lot going on with these political contributions that to me seems really strange. So State Farm cut his legs out from under him. It took essentially the same deal they offered the lawyer and took it to the insurance commissioner and offered to make it available to policyholders through the auspices of his office. Policyholders would get all the benefits without needing Scruggs to do anything. The only difference was that SKG couldn't get the extra 10 million or 12 million cross action fees, but so State Farm paid out 74.8 million to policyholders. Pulling out of the class action was one of two grave miscalculations Scruggs made. The other would involve dispute with SKGA over divvying up to 26.5 million. So he got a little too greedy. On March 28th, Balucci met with Lackey and said he considered a personal favor if he would rule for Scruggs. He added that when Lackey retired, he hoped he would take on an of-counsel position at his firm. So though he kept a poker face at the meeting, Lackey later notified the FBI and offered to tape record future calls. So he knows he's getting bribed and he's going to get elected. So on June 15th, this judge overseeing the case recommended that Scruggs be prosecuted for criminal contempt for allegedly violating an order he had entered requiring return of all documents. He suggested that Scruggs disobey the order to further a plot in which Scruggs and Hood had teamed up to bully State Farm into civil and criminal settlements. At a tape meeting, Judge Lackey asked Balucci for $40,000 in exchange for the order he wanted. Balucci called Scruggs and he got the green light. He delivered the last payment November 1st and the FBI arrested him. Balucci discussed with Scruggs whether Lackey's draft order read the way he wanted and told him Lackey wanted an extra $10,000. And Scruggs says, I'll take care of that. You know, when you have $800 million, why are you bribing with $50,000? I mean, it seems like you should go a little higher than that. As the probe continued, Balucci told FBI that he had helped Scruggs to try to bribe a different judge in Jackson in 2006. So everything's coming apart here. You know Balucci's getting the deal from the FBI, right? For reduction in time if he turns over Scruggs. Why wouldn't he turn over Scruggs? These type of people, what kind of loyalty do you have here? Man, of course he's going to. In the 40 days before the election, Scruggs, a close associate and two of the lawyers, contributed $472,000 to the Internal General Association, which in turn gave $550,000 to Hood's campaign. Hood's total donations that year were about $739,000. He won the election. So not only was the lawyer contributing, but he was a big chunk of his election campaign. To me, 2.1 million sounds like a lot of money for an attorney general race in a small state like Mississippi. So that's a lot of money. Anyway, this is our industry. So State Farm, you know, we don't know if their problem with the engineering report is they really thought it was done incorrectly and they needed another one because they thought it was wrong, or they just didn't like the results and they ordered another one. But as far as I know, State Farm is the only one that had that issue. You would think if people disagree with State Farm, they could take them to court on that engineering report and have a class action there. That didn't come up. UTSA was probably one of the other four companies, probably Farmers, probably Allstate. You know, the big guys are all part of this. But State Farm's the only one that really got the bad press here. So anyway, that's the industry. If you want to work in this industry, that's what this industry faces. If you're an actuary, you don't care about any of that. You just want to know frequency and severity. That's all you care about. How much should I charge? I don't know any actuary says, hey, can we really rip these people off and charge more? No, they have a professional standards. This is what we do. This is how we file our claims. So anyway, all right. So let's talk a little bit more about homeowners related to this issue of storms and hurricanes. So what I want to do a little bit of background on catastrophes. I think what I'll do is maybe next Tuesday, I'm going to go back over the exam question, let it sink in a little bit, the exam question on mold and storm surge. All right, I'm going to put a break in between those and jump to the next topic because you're probably getting worn out on those two topics. So Tuesday night, I'll go through mold and storm surge. I'll show you the rubric, make sure you have a clarity on it. Hopefully you got your paper one already written and ready to go so you can start working on the exam. So let me show you some. So homeowners, catastrophic risk is huge for homeowners. It's probably the biggest thing people worry about are major catastrophes. So I want to show you this first article I find really fascinating. Some of it I think is almost humorous. So the first thing is, what can we do about these hurricanes? There's any way we can improve so we don't have such a huge issue. And there's this one guy from Stanford University. He said, if you give me $1 trillion, he would design a wind farm off the coast of Louisiana to protect New Orleans and the neighbors from hurricane. Turbines would steal energy from the hurricanes, which would make them somewhat less destructive, but that would not be enough to have a big effect. However, by extracting this energy from the winds, serried rows of turbines hundreds of kilometers long would also calm the waters over which the hurricane's eye, which is the hurricane's eye, it's driving force subsequently pass. So he says you could actually see, you might think that's impossible because you look at a hurricane on the map and it's, you know, the size of the state of Texas. How could humans actually build something that they have that kind of impact? There was a video I used to show in this class, but they've taken it off of YouTube, so I can't show it. There's a really good video. I'll share some of the data from it in a future class. But hurricanes actually kill themselves because as they come in, they actually cool the water that they're in. And the stronger they are, the faster they cool the water, and cool water kills a hurricane. So hurricanes actually do, unlike earthquakes, hurricanes actually do have an upper limit how strong they can get, because once they get so strong, they create their own cooling effect. And what he's saying is he wants to actually help that along. Cool the water enough so when the hurricane goes over it, it's cooler water, it doesn't create as much mass. So you still have a hurricane, it's just as a category 3 instead of a category 4 or 5, and that has a huge impact. Earthquakes, we don't know if they have an upper limit. We've had some earthquakes in the 9 Richter scale that are just massive, massive, massive. But hurricanes, there is an actual mathematical limit to what they can do. They cannot get stronger than a certain point. And he's trying to take advantage of that to try to bring them down. Would you spend $1 trillion to do that? Well, if it actually worked, you might actually save, you know, that times 5 or whatever over the next several years. Might be worth it. Lower its maximum speed by 50 to 80% will also reduce the amount of water surging, which is the principal cause of destruction, by as much as 80%. And when the turbines are not calming hurricanes, they can generate electricity. I don't know. Would it make sense? Who knows? Someone should do the cost benefit analysis of that and see if it worked. I don't know where he came up with $1 trillion. Well, he said an odd couple of $1 trillion. I don't know what an odd couple is. That 2 or 3? I don't know. All right, here's another article. Deadlier than the male. All right, so which hurricanes cause more damage? Hurricanes given a male name or hurricanes given a female name? Which causes more destruction? Female. Now, why would you think that? I mean, there's no logical reason to think that a female named hurricane causes more damage, but they do. Female hurricanes do cause. But anyway, have any reason why that would be the case? Guesses. Do you think people naming a hurricane say, oh, wow, this is a really strong hurricane, it reminds me of my mother-in-law, let's name Sarah? That's not what's going on. The people naming hurricanes don't name them based on the strength of the hurricane. No guesses at all. Let's read through this article. A study which claims to have discovered a link between the sex of the name given to these hurricanes and how lethal those hurricanes proves. Now, one thing I say, the word lethal is important. So female named hurricanes cause more lives lost, maybe not more property damage, but more lives lost than male names. Does that help you with understanding why? The reason has nothing to do with the storms themselves, but everything with people's reactions to them. High damage storms, though names matter a lot, those with masculine names would be expected to kill 11 people. Those with female names, is it a small difference? 59 people. Its most plausible explanation is that people do not take hurricanes with women's names as seriously as they do with men's names. Now, I'm not saying this. This is what the study is saying. They see a female name, say, oh, I'll just write it out. They see a male name, they jump on I-35 and they're out of the city. So I don't know. I thought that was kind of strange. So next time you hear a female name, you say, hey, let's get out of the city, people. They chose 5 male, 5 female names from last year. Both men and women reckon male hurricanes would be worse than female name. A second experiment compared perceived risk of made-up report about hurricane. The man's name was associated with more risk. So, even just quizzing people. Third experiment showed a similar response to the question of whether someone would think to evacuate in phase. Fourth showed this would extend even to obeying or not government suggestions. And the fifth and sixth experiment, you get this sense that they're like, there's no way this is true. Let's test it again. But so anyway, they try to find other things, how popular a name was or how old or new the name was. No, it's just whether it's female or male or female. His analysis does stand up and suggest that meteorologists and authorities might think about what? Just name them all male names. Now that may be sexist. I mean, are there like women's groups out there going, there's not enough female name hurricanes and they're protesting? I don't know if that would upset someone or not. Anyway. All right. So yeah, there's some interesting research on this. Now, should an actuary take that into consideration? Probably not, because homeowners insurance doesn't cover life insurance. And it's probably not material enough for a life insurer to care. So they're not talking about property damage, they're talking about deaths. So an actuary probably would not care on this. But government organizations would probably, this is something maybe they should take into consideration if it's material enough. It looked like it was pretty material. All right. Let's look at some history of hurricanes. So we know 2017 is a really bad year. Any of y'all from Houston? So were you there during Harvey? Was it pretty scary, or did y'all evacuate? Huh? Oh, no school. And y'all left because it was named Harvey, right? So you're really worried about it. And how do you evacuate Houston? I mean, it's just not possible, is it? I-10, it's just, did they open I-10 one way, both ways?
No, I wasn't, I was in Montgomery.
Oh. So you really weren't that exposed.
We were stuck in because it was flooded, it was right by the lake.
Yeah. Yeah, you got a lot of water, even if the wind didn't make it to you. So yeah. So yeah, Houston, I think Houston might have made I-10 one way. And maybe the frontage road or the access road was the only one you could go the other direction on. But yeah, it's hard to evacuate a city that large. So inflation adjusted cat losses reached an all-time high of $135 billion. Total losses, including uninsured ones, 350. So that's pretty big difference. The insured losses was 135, total losses was 330. So there was a lot of flood damage with Harvey. And you can see why State Farm, it's hard to engineer because it makes a huge difference in your losses. Worldwide catastrophe losses, there's the insured, there's the total. So this was the highest insured, but not the highest total. That looks like, yeah, you would think this would be Katrina, but it sure doesn't look like it's over 2.8. Maybe that's Katrina. That looks like 2011. This is worldwide, so that's probably Tokyo, don't you think? The Tokyo earthquake. Does that make sense? Wasn't that about 2011? Why is that mainly water? Because it was the tsunami, right? The water came in. It wasn't so much the wind damage. Fully 97% were weather related, well above the average. If climate change brings more frequent extreme weather, Munich Re, why does it say Re? Anybody have a guess? What does Re stand for? What is Gen Re, Munich Re, Swiss Re? What's the Re all about? Swiss Re. Lindy, if I were an actuary, I would want to work for Swiss Re, one of my favorite companies. So Swiss Re Insurance Company, Gen Re. Y'all remember from Warren Buffett, he had a, what was his called? Yeah, reinsurance. It's their reinsurance. What was Warren Buffett? I can't remember. General Re? Is it Gen Re? So yeah, so Re is reinsurance. Massive firms. There's not that many of them, and they're keep merging, so there's fewer and fewer of them. The data show many more frequent high loss events since 2000, lots of them weather related than in previous decades, but that doesn't necessarily global warming is causing it, because if you look historically, hurricanes do tend to come in kind of groups. Some of it has to do with El Nino and La Nina. But they do tend to come in those waves. So we've had some decades, long decades with just no storms whatsoever, and then a lot of activity. But there is a sense that maybe the volume is increasing. Y'all know what this word means? You may remember the definition, combined ratio. Is 105 good or 95 good? Which would you rather have if you're Warren Buffett? 105 or 95? Lower, right? Because the combined ratio is what you pay out over what you received. So 105 means you paid out more than you brought in. So they said the combined ratio went from 100.7 to 104.4. Even Warren Buffett's Berkshire Hathaway looks poised for the first year underwriting loss in 15 years. When was the previous one? 2001, maybe? Right. Now, Warren Buffett owns Geico. Geico didn't lose anything because it doesn't do homeowners, but Berkshire Hathaway does lose money on these because of the reinsurance. So they lose money anytime there's a massive, massive loss like that. Maybe I should go back to the 2007 Warren Buffett report and read what he said there. See if he brought up his same argument he made, and see if, you know, say, we thought we learned our lesson back in 2000, but maybe not. These forms of alternative capital will reach 89 billion, now make up around 14% of total. So here you're talking about, we're going to talk about this collateralized reinsurance. We're going to talk about securitized. You're actually going to do a math problem on the first exam related to these kind of cat bonds. Are really, really interesting. And the reason that they become important is because the reinsurance industry is so concentrated. People are starting to worry that a big event like this is going to take them all out, because they're so there's just only 4 or 5 of them that are really massive. So we're going to talk about the catastrophe bonds. The proportion of all losses covered by insurance is still too small. Much risk is retained by governments. A lot of it by governments, that's the flood, are just completely uninsured. No insurance whatsoever. Now you can go out and get, it's pretty easy to find articles, and well, here's III, the Insurance Institute, something. There, you know, we're talking about your paper for paper 2. Here's another place you can go. I should put this. I don't think I put this in the notes. I can't remember. The Insurance Information Institute would be a great place to go for an article to your paper 2 topic. So natural catastrophe loss in the United States by peril 2021. You can see what the losses are: 92 billion, 162, 69 billion fatalities. Winter storm took out 230 people. Drought, wildfire, 229. Number of events, 64. Severe. What is that word? I don't know what a convective storm is. You know what a convective storm is? Is that a hurricane? Tropical cyclones. So you can see what they are. Yeah, archive data that you can bring in. So really, really good. You can stuff you can use.
Storm is a UK term of saying thunderstorms.
Thunderstorms, okay. The other place you can go for paper topic, possibly NOAA. Great website. I don't know if y'all ever used this website. I go to it every time there's a hurricane. I wish this class was in the fall and my life class was in the spring, because we don't have hurricanes. in the spring. We have hurricanes in the fall. So during that class, we'd be watching NOAA. But y'all see all the hurricane activity going on right now? Not much, right? Pretty limited. But what I love about this site, I actually did a presentation where I went to the site and I put every single one of their maps for every year and did it in order, just to see if visually you could see if the volumes were actually increasing because of global warming. But they have an archive in here somewhere. I just don't know how to get to it. Let me try NOAA archive. And we do hurricanes. So let's try, when was Hurricane Katrina? 2008, right? Or not? No, 2014? 2004. Let's see. Well, I don't see it there. Was it maybe 6? 2005. There it is, Katrina. Now, Katrina's year had other really big events as well. Y'all remember Wilma? I remember Wilma just because I always thought of Fred Flintstone. Y'all probably don't know who that is, but I would always, every time I heard Hurricane Wilma, I could hear Fred Flintstone yelling her name out. But they give you these charts, all kinds of information, maybe more than you could deal with. I mean, look at the kind of detail. Boy, this thing goes on for 43 pages. So you get really good data on any kind of storm you want to do research on. And here's the chart. So I took these charts that show every year and I just took every one of them and put them into a PowerPoint, one after the other, just to show. So you can see this is a pretty busy year, can't you? Now, where is Katrina? Good old Katrina. Oh, this is 2017 because there's Harvey. How did I get, no. They had a Harvey in 2017, 2005. So Harvey came back twice. But here's Katrina, she's number 11. And y'all see number 11? Where is she? Where is she? Where are you, Katrina? There she is, there's an 11. No, that's not 11. Here she is, here's 11. So she goes over here and she reconstituted again. So she actually went through Florida, hit the coast, built up steam, and went back and hit New Orleans. So you can track these. I just wish, so here's an 11. I can't tell which one's which. That's kind of part of the problem because they kind of overlap each other. But pretty busy hurricane season. You do 2017 with Harvey, we can look at Harvey. There's all the data on Harvey. You can see they've gotten a lot better with their write-up. And then not as busy of a year with Harvey. Now, we can probably track Harvey, can't we, pretty well? Number 8, can y'all see number 8? There's 8. So is this Harvey here? Looks like it. But see, I don't know which way to go. I'm assuming here. That doesn't look right. Harvey hit right here, right? So I'm having trouble following. It's just too hard for me to follow where they're going. But we know Harvey hit in this part of Texas. So I don't, maybe it hit here. Maybe this is Harvey here. That looks like an 8 right there. But it just stops there for some reason. So I'm not following it very well. But you can see it wasn't that particularly big of a year, but some years, and I don't know what year to show you. We can look at 2020. 2020 was pretty busy. Last year, pretty busy. Look at 15, almost nothing. You had this one started right there, so you can get much damage. And you notice a lot of them, y'all remember, oh, what was her name? The one that hit New York, not Stacy, like Sandy. Yeah, Sandy, so they named female names, so that wasn't good hitting New York. Sandy was very, very unusual because one thing you'll notice is the storms that go up the east coast, they tend to turn right. They tend to hit that cold water and they turn right. Sandy didn't. She decided to turn left and go right up the bay and caused enormous amount of damage. She was a very unusual storm. It's really unusual for that far north to have a storm hit like that. Now here, they tend to come in the coast and you never know where they're going to hit. They can hit Mexico, they can hit Texas, they can come back and hit Florida. It's really, really tough to tell, but it's actually quite rare for a storm to go up the East Coast. A lot of times they turn and hit Bermuda or something, you know, some major island chain. 2014, not much activity, hardly anything hit land in 2014. 2013, very, very little. They may remember when Sandy was. Boy, I can't remember. Hurricane Sandy year 2012. So Sandy should be pretty obvious because so few of them do. So that must be Sandy there. I can't imagine that it's not. Unfortunately, I can't read. Is that 18? Looks like. But I can't tell. But they need to really work on their site because it's really hard to tell. But my guess is that's got to be Sandy because it's the only one that hits that far north. But you know, see all these other storms that just turn right. And I don't know what the deal with this one was, but maybe it's coming this way. So anyway, it's a really great site. We're going to talk about cat bonds. What I'd love to do, if we could do this in the fall, since this class is not in the fall, is take a catastrophe bond. We're going to talk about a catastrophe bond. It's a bond that loses money if a hurricane causes a lot of damage. And I'd actually like to take a cat bond when a major hurricane's in the coast, and actually take that bond and put it up on Bloomberg and watch its price as we get new information on the hurricane. I think that'd be really cool to watch. How much does that price drop as it gets closer to land? Because 10 miles can make a huge difference. I don't know if any of y'all have ever been to South Texas, but a massive hurricane could hit South Texas and not do any damage at all. Maybe a few cows might die or something. But any of y'all driven South Texas? You can go hundreds of, I think they had the sign, what, next gas station, 226 miles or something like that, something crazy. There's just not much there. You hit King's Ranch and it's just not much there. So, but if you get further up, Corpus Christi and Houston, massive damage. So which way it turns makes a big difference. And I would just love to watch the catastrophe bonds price jump up and down as you get new information. I don't know if you could do a paper off of their site. I think you can tell some of this stuff, it's just incredible amount of information. Just, what is it? 157 pages. What's in there? You know, you just a lot of information. But if I'm an actuary, I might need half of that information. It might be important to me. If I'm a modeling company that actually models hurricanes, I might be looking at all this stuff. What was the air temperature? What was the water temperature? Which way did it turn? Why did it turn that way? What caused it to do that? What did it do once it hit land? Some of these storms, they hit land and they're no longer hurricanes, but they cause major flooding many miles into land. Some of them hit land, turn right, go back into the ocean, build up again and hit land again. Kind of like the way Katrina did. And they actually Katrina was actually two catastrophes. She hit Florida, caused a minor catastrophe, then she hit Mississippi and Louisiana and caused a major catastrophe. So that's what a modeler has to do. They got to be able to model what these storms can do. They got a lot of examples here, right? You got a lot of storms here you can look at. And that's where the El Nino and the La Nina come in, try to figure out what's going on with the Atlantic Ocean and those type of things. So there's a lot of things that can impact these storms. So what I want to do is, you can see I'm really eager to do some math because we haven't done any math yet. So I want to jump into the math. And then we'll come back and talk some of these issues on the other side, just because you want to use your calculator, don't you? You're some actuarial majors in here. So I want to talk about catastrophe bonds. It's a brand new type of security. Well, it's a little old now, but it's younger than you are. And I do know how to spell example. So catastrophe bond is a special type of bond that pays you depending on how large the loss is. So to be able to do cat bonds, we've got to understand something called probable maximum loss. All right. Let me find in the notes as well, so we can class notes. All right, let me load the class notes real quick. So let's define problem X loss. Let's calculate it, and then we're going to then hedge that risk using catastrophe bonds. So catastrophe risk, there's the NOAA site. There's a few other places you can go. So I do have the III in there. Here, I don't know if this article still works. Let's look at it real quick. There are a few articles I found that were really actually quite exceptional. Yeah, it's still there. 30 years of devastating hurricanes. There's Sandy. So that looks like the picture I showed you, doesn't it? Y'all saw that? So Sandy was supposed to turn right. And somehow her GPS got messed up. And I don't know what, and that's the thing is, you know, if you're an actuary, it's like, what was the weather temperature? What was going on with the water temperature right at that point? Exactly what's happening here that caused it to turn left instead of turn right. He caused 72 deaths and 87 indirect, more than $50 billion in 24 states. That's pretty amazing in itself, 24 states. And it looks like it went over Cuba as well. I don't know if it did damage in Cuba. So there's Sandy. And there's a picture of Sandy aftermath. Then there's Irene. I remember Irene. You notice we're talking about the most difficult ones, and they've been two women's names so far. 41 deaths, $15 billion in damage. This is another one that didn't turn right, just kept going straight up. There's a picture of her. Here's Ike, finally got a male's name. 2008. So there's, you know, there's some, I remember hearing Ike, but today, given, you know, everything that's going on, we kind of forget some of these, but $30 billion, that's a pretty big size storm. 20 deaths in Texas, 28 direct and indirect in 8 other states. So it did some pretty good damage. I think Ike is the one that wiped out the Texas timber industry. I know most people, if you go up north and say Texas has a timber industry, they probably think you're joking because they think Texas is one big desert with a bunch of cowboys. But East Texas is a major developer of timber, and Ike did enormous destruction to that entire industry. Any of y'all experience Ike? Hannah, you might have been in Ike as well. So Katrina, obviously we talked about Katrina. So here's Katrina. So you see how it did damage in Florida, and then it re-strengthened, and then it hit New Orleans, Louisiana, and continue going up. Look at the deaths. 1,800, not the most deadly. I think Galveston's hurricane is still the most deadly in U.S. history. $108 billion, but how much of that was insured? Because a lot of that was flood damage. So that one wasn't as bad. I remember these pictures. I remember people on top of their houses waiting for a boat to come along. Rita, I remember Rita, 2005. Isn't that the same year as Katrina? 2005 was a horrible year. $12 billion, 7 deaths. in almost the same place. Just go to Rita, Wilma, and how many have been women's names and how many have been men's names? Ike is the only man so far, right? 5 direct deaths, $21 billion. There was Wilma, that was all Florida. I don't know what Beta is. Is that a male name or a female name? I know Beto is a male's name because he runs for Congress, but yeah. None, that doesn't make sense for me. So it didn't hit the US. Nicaragua, October 30th. So category 2. I don't know why that one's even on the list. It didn't actually cause deaths. Ivan, I remember Ivan, 2004, 25 deaths, $19 billion. This one's pretty interesting, isn't it? That's pretty wild that it would do that. Hit there, hit there, and then hit there. That's pretty wild. Floyd, I do remember Floyd, 6.9 billion, but look at that deaths, 56 deaths. That's pretty heavy deaths. Andrew, now Andrew was the one that got our attention. I was at USA, y'all weren't alive in Andrew, I guess. That was 30 years ago. So y'all weren't even, your parents probably weren't even married when Andrew hit. But Andrew is what shocked the industry. At USA, I remember we're trying to calculate our PML. We're going to talk about this problem max loss. And we're saying, what's our worst case scenario? What's the worst we could lose? And then Andrew hit, and we were looking at a 1 in 500 year event of being like, I don't know, just a pretty small number. And then Hurricane hit, Andrew hit, and it was a much bigger number. And we're thinking, wow, Hurricane Andrew must have been a 1 in 800 year event. And then the modelers went into their models and said, no, Andrew was like a 1 in 50 year event. The problem is your calculation of your worst case is way understated. And the whole industry suddenly said, you know, we got a lot more exposure to the homeowners than we realized. And why is that? Well, because up to 92, there were very few hurricanes. And suddenly Andrew came in and we discovered that, man, we're going to lose a lot of money in this industry. So Andrew came in, $26.5 billion. That would have been considered a 1 in 500 year event, but it ended up only being 1 in 50, caused quite a bit of damage. Woke up the entire industry. Hugo, y'all heard of Hugo. It was before Andrew, but didn't cause nearly as much damage. So, you know, there's some storms you probably have heard of that are interesting, interesting histories. And here's another one with some history. This one I think is more than just hurricanes though, but we'll see if the article still lists. The 11 most expensive insurance losses in recent history, but it's as of 2012. So recent history, so ignore. So typhoon, whatever. Charlie, I remember Charlie, 9.3 billion. Rita, we just saw Rita. There's what I'm talking about. That's what it looks like when the entire city of Houston leaves at the same time. And yeah, people who just run out of gasoline. Wilma, we saw that before. Ivan, we saw that one before. Ike, we saw Ike before. Northridge, y'all remember Northridge, or y'all weren't alive in Northridge either, were you? What year is that? 19, okay, sorry, y'all weren't alive. Northridge is really interesting because it wasn't as bad as a hurricane, earthquake, as the damage ended up being. So the model said, given that earthquake, your losses should have been, you know, $5-6 billion and ended up being $20 billion. And what they discovered was California had all these buildings that were equipped, ready for an earthquake. They were earthquake protected, so they could take all this swaying. And so insurance industry is thinking, wow, well, these buildings were protected, they're not going to fall, and they didn't fall. But then the adjusters went in afterwards and they said, yeah, the building didn't fall, but you got to tear it down and rebuild it because the damage, you can't have occupants in this building. The damage is too much. So the building code, what it did was keep the building from collapsing to kill people, but they still had to tear the entire building down and rebuild it. But that's the case. It doesn't help that you have these new building codes. They still had to tear them down. There was some pretty, I think, morbid stuff going on with earthquake. I just remember a famous newscaster. I won't say his name. I'd rather not say his name. A famous newscaster, and he was like, "I need dead bodies. Where are the dead bodies?" He was like, "Get around the city. There got to be people in crushed in cars somewhere." It's like, come on, man. You should be happy there aren't dead people everywhere. So fortunately, the death count wasn't as bad, but the property damage was pretty extensive. 9/11, obviously, 23 billion. Hurricane Andrew, the Tokyo Earth tsunami, 35 billion. Yeah, that was 2000. So that's why that 2011 jumped up so much. And then Katrina. Now Harvey would have gone in there somewhere because this was as of 2012. I don't think there was anything else between 2012 and today besides Harvey that would have hit in there. So you see what the biggest ones are. I don't know why there's a pig sitting there, but anyway. So what is a probable maximum loss? And why do we need that when we're trying to protect an insurance company? So you had value at risk in a previous class. So hopefully you remember value at risk, but if you don't, value risk and PML are essentially the same thing. So a value at risk, a probable maximum loss is your expected loss at some probability. Okay, how many of y'all have had value at risk in here? A couple of you. So those in my risk management class, you're going to get it again in that class because we're going to talk about it. But value risk is often a number that's a daily number. How much could we lose or more 1% of the time on a daily basis? So those of y'all doing the banks in my other class, you're looking at numbers like 35 million, 40 million. We could lose as much as $45 million 1% of the time. Probable maximum loss is an insurance term, and it's usually an annual number. How much could we lose in a year? Or it can be an event number. What's the biggest event we could lose 1% of the time? The other difference between probable maximum loss and value at risk is the probabilities are much smaller on probable maximum loss. So value at risk, those doing Goldman Sachs, you might see a value at risk at a 10% probability or 5% probability. I think Goldman Sachs is 5%. Insurance companies are looking at 0.2%. Extreme, and actuaries, they're way out in the tails. Very, very, very rare events. That's why they talk about 1 in 500 year events, 1 in 100 year events, and are doing annual. So Goldman Sachs might say our 5% borrow on a daily basis is $35 million. UTSA, a much smaller entity, might say our 0.2 PML is $3 billion because they're looking at an annual number and they're looking at something that doesn't happen all that frequently. So I like to always write the PML with the probabilities. So I'm using 0.2% because that's what UTSA used. UTSA was a 1 in 500 year event company. So if you say a PML at 0.2 probability, you're saying 1 out of 500 years, we would expect not to lose $500 million, but to lose $500 million or more. And one thing I learned with actuaries is or more is a very important term to them. They want to know what that or more is. And boy, they're really picky on that. What do you mean 500? So you mean it could be 800 million, could be $1 billion. And so the actuaries actually, what they wanted to do was they wanted to build a distribution. Y'all know what a distribution is, right? They wanted to build a distribution just of the tail. They wanted to take that 0.2% probability and they want to build a distribution of the 0.2 probability. It's like, man, that's really cool. How do you do that? Which means you can't run 1,000 simulations. You can't run 1 million simulations. You got to run like 10 million simulations. So yeah, they have a lot of computer. They need a lot of computer power. Now that's property and casualty laws actuaries. The life insurance actuaries, they were fine with 100 simulations, 200 simulations, but the property and casualty guys, they wanted millions of simulations because they really want to understand that or more. So the insurance company expects to lose $500 million or more, 0.2% of the time, or they expect to lose no more than $500 million, 99.8% of the time. Okay, so how's it calculated? First of all, they run stochastic models. Here's two groups. Here's two great, if you're an actuary, I would really encourage you for your paper 2, consider this as your source for your paper 2. These are great firms, very interesting firms. If you're an actuary, this might not be a bad place to go work. Wow, Moody's bought them out. That's pretty amazing. So Moody's is buying everybody. But they have a lot of articles. That's pretty cool. A risk management company at the forefront of risk intelligence. That just sounds really, really cool. And one thing they do is catastrophe modeling. Insurance companies don't call it catastrophe modeling. What do they call it? They call it cat modeling. I made a mistake of using that term. I met Dr. Ibbotson once, famous guy in finance, and I start talking about cat risk. He has no clue what I'm talking about. Cat risk, what do you mean cat risk? Cats aren't all that dangerous. I'm sorry, I mean catastrophe risk. It's like I was using my industry jargon with this, famous guy in finance, and I make a fool of myself. It's like, what about cat risk? And he's like, I don't know what he was even thinking, cat risk. He probably thought it was an acronym. CAT stood for something, but no, it's just catastrophe risk. Understanding catastrophe modeling. There's a lot of stuff here. They have videos. So you could probably write a pretty decent paper off of this. I don't know whether they're all drinking coffee, but they probably have jobs as well. So you could probably apply for a job here. I don't know if I would work for them if they're owned by Moody's now, but still interesting firm. They have all kinds of interesting stuff. Season of Flood webinar series. Resources, you can go in there and look. They got blogs, case studies, publications. It's just a lot of really good stuff in here. The 2020 Catastrophe Review. Infectious disease modeling. They model COVID. One great paper, I should show you this paper. The student, she was an actuarial student, so she really wanted to get into this stuff. She wrote a paper on COVID's impact on the property and casualty insurance industry. And boy, she went into it. I actually sent her paper to one of my friends at UTSA because I was like, man, she really got into this. Pretty interesting. Data that drives mitigation, adoption, and resilience, investing in flood risk management defenses, cyber risk is a big topic. You could probably write your entire paper 2 on cyber risk and just use RMS as your source. Cyber risk outlook for 2019. Workers' comp, risk assessment, California earthquake, solution assessment, risk strategy services. So all kinds of free stuff out there. If you click on it, you can see how big it looks like you have to submit. I don't think they charge you money. I think this is all free. So you just have to give them your personal information. So that's RMS. RMS, well, I'll let you guess. RMS and AIR are the 2 biggest ones. One is real famous for earthquake modeling and one's really famous for hurricane modeling. Can you guess which is which? Which one do you think is the hurricane modeler? Yeah, AIR is a hurricane, but they both do both now. But AIR was traditionally the hurricane guys and RMS was the earthquake guys. But they both do both. I don't know who's bought out AIR, but another great firm. AIR Worldwide Risk is now Versic, so there's their software. They also have support and training insights. So again, you could certainly go to their site and find all kinds of articles. Managing U.S. service thermostat risk, another very active Atlantic hurricane season, 2021. Next generation financial modeling for commercial lines. And just all kinds of stuff that you can find articles on. Here's one, managing U.S. terrorism risk. I look back at OKC. Man, that seems really, really old, right? Yeah, y'all remember OKC? Isn't that the Oklahoma City bombing? Is that what they're talking about? 1995? Why are they talking about that in 2021? There's the earthquake in Tokyo, new framework for global climate simulation. So climate risk is definitely something you could write your paper 2 on. There's a lot there. You can find all kinds. So any of y'all are saying, I can't find a topic for paper 2. The problem might be there's too many options. You just need to find, what I would do is just go find a bunch of them. And what you're trying to find is one really meaty, good article that you can really use. And then you can find a few others. It's not a research paper, so you don't need 50 articles, but just all kinds of stuff going out there. Climate models and catastrophe model context, hurricane season, record 2020s, the anatomy of a climate model. So there's all kinds of stuff out there that you could certainly work on. So this is something that's very well researched because it's such a big deal. But you could see that air and RMS, they're beyond just hurricanes and earthquakes. They're looking at flood, even though the industry doesn't really get exposed to flood. They're looking at COVID. They're looking at cyber risk. They have stuff on the life insurance side. So that they do a lot of modeling. They hire a lot of engineers. They hire a lot of weather people, meteorologists. So it's an interesting field. Would be a great place to work, I think. You'd be so specialized. But I just don't know what jobs they have. If I were an actuarial major, I would definitely be at least applying for jobs at these firms because they're so well known. Now, they've had some really bad press in the last few years that their models have some serious problems. There's a really good podcast out there. I should show it to y'all. It's a podcast that really focuses on the insurance industry, and they've had some podcasts where they've really criticized these 2 companies quite significantly. You could write your paper 2 off of that podcast. You'd have to take notes really fast, but there's some interesting articles on that kind of stuff. So there's a lot of stuff in this industry I find really interesting going on right now. So they're trying to model the book of business, and these models have gotten quite specific. It used to be, give me how much property in a zip code. Now it's like, give me the addresses, the street, and the number. So their modeling is getting quite precise. They run simulations. So it's just like, there's no way to do this with mathematical models. You've got to just run simulations. It's just too complex. They want to look at how much is it going to cost to rebuild these houses. They got to consider things like demand surge. If a hurricane takes out a bunch of houses in Miami, you have to rebuild these houses, but you're not going to have enough construction workers. So construction costs are going to go up. The wood prices, concrete, all these prices are going to go up. How do you model that? What about ALE? Y'all remember what that is? Additional living expenses. If you have to put people up in apartments, that's where they really messed up on Hurricane Andrew. It takes a long time to rebuild that many houses, and you got to put people up in apartments. The ALE, these modeling companies grossly underestimated that. Every time there's a new storm, it gives them a chance to retool their models. Now, the CEO at UTSA, he was convinced every time they fixed their model, it gave bigger numbers. Because you keep telling me the PML is a larger number, but there are times where they actually reduced. There have been storms that did less damage than they're expecting. But it does seem like the majority of the time it adds more. Once they get those simulations, I mean, it seems like it's too simple. But if you do 1 million simulations, you just take them, put them in Excel, and you rank them from least risk to biggest loss. And then how do you find your PML? Right, so let's do it. Well, we don't have time. All right, next class, you're gonna calculate the PML. We're gonna do exactly like it's gonna be done on an exam. This is a question most students get 100% on, so it's kind of a give me question. But it's not simple because I've watered it down for you. This is exactly what we did at UTSA, all right? So there's no watering down here. It's actually, the hard part is doing the simulations. But assuming the simulations are correct, getting your PML is actually a piece of cake. All right, so we'll start there. Any questions, anything?